Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial professionals John and Michael from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. John, how are you?
You're great. How are you, Eric?
Doing fantastic. I know that you have a return guest on the show today. Michael, you're bringing back a guest from the last podcast. So listening audience, the last podcast was a great foundation for, a lot of knowledge was passed to the audience. Plus, it's a foundation for what they're going to be talking about today, which brings me to Michael. What are you guys talking about today?
Well, we have Chris Graham back on the podcast. How you doing, Chris?
Good to be back.
Excellent.
Hey, Chris.
Good to see you, John.
Chris Graham is the CEO and founder of Crown Capital Investments. And on part one of our adventure here with Chris, we talked a little bit about the private equity world, the alternative investing world, and we wanted to pick up, Chris, with this part two. We touched on it a little bit in the first episode, but this concept of, again, this is an asset class that a lot of people that we work with have heard about, but they're not really sure. It's a very complicated world. And I think where we might want to start today is if somebody were to ask you about investing in this world, what are the things or questions that they should be asking the fund manager or asking their advisor about a recommendation that might be made to them in this space?
I think if somebody introduced me to a fund, said, I think this might be a good investment for you. First of all, if it's advised to me by an investment advisor, something like that,
sure.
Nassim Taleb says something that I think is it's pretty iconic. He says, if you want to get advice, then ask somebody for advice, and then afterwards, ask them what they do, right? So a lot of times, the advice you get from the doctor will be very different than what the doctor actually does. The advice you get from the financial advisor will be very different than what the advisor actually does. So ask them both for what they're doing as well as what they're advising. A lot of times those things are a mismatch, which is telling. So I would ask the advisor if he has money in the fund, first of all. But the second thing that I would do is say, okay, consistent with what we talked about last time, what is the investment thesis? And Michael, you actually made me think about this. How in detail should that thesis be? And I think you should keep asking why about that thesis until you understand why that thesis makes good investment sense today, right? When we talk about some of the macro effects that can impact an investment and an investment thesis, federal rates, are we in a high or increasing rate environment versus a low or decreasing rate environment? How would that impact this thesis, right? Where are the companies in a cycle of the macroeconomy? What's the math behind what they're doing? Simply to say that we're good at managing consumer or retail companies probably isn't enough of an investment thesis. That's just a skill set. That's not about an investment. Now that skill set can be part of the thesis, but I think it needs to be part of that. So I would keep asking why about the investment thesis until I really understood why this made sense for me as an investor. The other thing that we're very careful about, we build a lot of time, we spend a lot of time, energy, and effort about building low risk profiles. So I would ask very specifically about how much debt does the fund carry?
Right.
Debt correlates 1-to-1 with bankruptcy. It's amazing. More debt, more bankruptcy. It's a 1-to-1 correlation. And so we believe in lower leverage, but ours is drastically low. You just won't find private investments that have leverage as low as ours. We are at 1 times our profit in debt right now. The average, I saw a Forbes article, average for private equity is 6 times profit. 6 times. On deals over a certain equity size, larger deals, the debt is 7 times. And for less or smaller deals, it's 5 times on average. But the average is 6. We're at 1. Right. And the reason they take high leverage is because they can buy more companies with less capital. And then as the companies generate cash and pay down that debt, it increases the yield, but it's increased yield with a much higher risk onboarding process. What we have found is if we take low leverage, like 1.5 times profit, we pay it off as fast as we can. And then we borrow another 1.5 times, pay it off as fast as we can. Then over the same length of time with the same growth on the businesses themselves, we get 94% of the yield of a high leverage model with 1/20th of the risk. So we have a different way of doing it. But I would ask, that's an important question. How much debt do you build into your model? Like, what's your carrying debt? Because if they get stuck in an increasing interest rate environment, just like the Silicon Valley Bank did, right? You could end up with asset values collapsing due to the refinancing need of the fund itself. So I'd ask about debt. And then I would ask about the team and their experience and their process of engaging with the companies. There's also a very specific difference between what we call a buyout fund. That's what we are. We're a buyout fund. We buy the companies and we run them versus a minority investment or non-buyout fund. So non-buyout funds put money into companies for somebody else who's already on board to manage versus buy the companies and manage themselves. Two different models. I'm not saying one's better than the other. We just have a system that works well for us to manage these companies. But minority funds can do well. In that case, you want to make sure there's a lot of robust process around evaluating management teams, right? So those are probably the biggest questions I would ask.
Yeah, that's great information. I mean, with the debt in particular, and even how the debt can be structured within the fund. I mean, it's a very complicated world. You really have to be working with qualified people that do this every day, and hopefully, if you're out there listening, working with an advisor in this space, that they have experience. I would even ask them what their experience is in terms of evaluating a fund at this level and what their experience is and their process. So it's there's a lot of variables here to manage.
Yeah. Layers of them. Yeah, definitely.
Yeah.
And obviously, like most things, fees are important. You want to ask about, the inherent fee structure. We have an interesting fee structure. Most funds employ what they call a 2 and 20, 2% management fee paid annually. And it's 2% of the assets under management. So 2% of the value of the fund, and then 20% of the profit at the back end when you liquidate. Well, that 2% of the assets under management, what I wanted to do was to neutralize any valuation issues. So we are a 1.5 of acquisition value. If we buy a company for $10 million, we get a $150,000 fee. If we grow that company to $50 million, it's still a $150,000 fee for as long as we own that company. So we are a non-mark-to-market fee structure. So over time, as the companies grow in value, our fee actually slides down to very low sustaining fee, like less than 1% to sustain the fund.
Chris, this is John. How do you evaluate the companies that you approach? Is it you said you have a system, but what's your instincts on these companies? Is it a certain sector, or the sectors don't matter, or is it a certain age group of the business owner that you're looking for? How do you look at a company and say this is a company we need to invest into?
Yeah, so it starts with our filters and our investment thesis. Right. So our investment thesis is very mathematical, and it is based on demographic shifts, not just in the United States, but for us, investing is mostly in the United States, and it's based on the baby boomer exit. Baby boomers were an incredibly entrepreneurial group. 77 million baby boomers. 4% of baby boomers have achieved 3 million of net worth. Wow. So call it 3.6 million rich baby boomers. To achieve that level of net worth, primarily they owned their own businesses. So one statistic is, I've seen it a couple different times, it's all in a range, but between 12 and 14 million baby boomer owned small businesses in America today. It's huge, right? A huge number of businesses, 14 million of them. Now, what we have found is that at under a certain level, call it $2 million, right around that range, there is really insufficient management in those businesses. And the baby boomer is really running the business himself. And over about 5 million of profit, we get institutional buyers looking to buy in that space. So the pricing starts to spiral up. But there are a ton of businesses between 2 and 5 million that are baby boomer owned, where the baby boomer has no succession plan, no kids that they think could run the company, no real opportunity to sell it to a bigger fund for higher multiples. They want to retire. They tried to grow it. They haven't succeeded in growing it. So we get really good purchase multiples on really great, long-lasting, durable companies in that space. So we target baby boomer-owned companies without a transition plan that have been had long-term sustainable profitability.
Right.
Then, of course, we due diligence them to death. I mean, we do a forensic accounting basically for 3 years. We start with the checking account, and we move to the profit and loss statements, to the tax returns. We do a 3-year forensic scrub of the company.
Oh, I know how you think. I can see you
based
do
on
that.
my accounting background.
I know how you think. Chris, real quick, and this might be a little curveball for you, but AI seems to be in the press daily now. How would you consider using AI to evaluate companies to purchase, or is AI a factor in what you're doing going down the road of success for your organization? Is that something you're looking at?
Yeah, I've played with it. What I have kind of figured out for today, now I think it has great potential, but for today, it doesn't really add much value.
Okay.
Because the data it pulls, really what it's pulling is our own human knowledge. Like, it's not creating new knowledge, and it's not even really creating new insights from that knowledge. The AI that we see today is just a hyper search function on the internet. It's pulling that knowledge and repeating it back to you in maybe a very pleasant way, but it's not creating or analyzing knowledge. And the trick is that you don't know where it got the knowledge from. So it's not necessarily trustworthy, right? So we've tried it a little bit just to see what it would do, but found it to be not much more valuable than our processes, and also somewhat problematic in areas.
Yeah, not yet. It's not doing those things yet.
Yeah, not yet.
Maybe,
exactly.
maybe in the future. Chris, we talked a lot about debt and how for certain funds that can, it's definitely an important question if you're analyzing an opportunity that you should be asking the manager or your advisor that you're working with. But I'm wondering if there is a pro or a benefit to the rising interest rate environment, i.e. a place or an asset class, more private credit, which I don't think is really where you guys hang your hat. But I'm wondering if you have any thoughts on that sort of sub-asset class within alternatives.
Yeah. So private credit versus private equity is the same as credit versus equity. Credit sits ahead of equity. So it takes less risk. It also gets less return. But it's a pretty good place to sit. It might have been better earlier. Right now, you're getting squeezed a little bit because you can get some rates from dividends and treasuries that are kind of squeezing up against the rates that you might get in mezz financing or some private credit. But what happens in private credit when industries get squeezed in a recession, these funds get access to acquiring these companies at really discounted prices. So it can be a very interesting space to be in. Golub Capital is a big one in that space. They're private credit functioning machine. We actually built our model to mirror private credit, but to be private equity, so we get higher yields. And the difference is this: most private equity does not generate cash flow annually in the fund or deploy that cash flow, right? It's all about paying off the debt. All the cash flow goes to pay off the debt. Because we have low leverage, we actually generate cash flow more like private credit. So that's the difference. Private credit is that debt that is pulling cash off the company, versus private equity is the one servicing that cash obligation. For us, because we eliminate the credit component, we function as a blend, higher yields like private equity, but also generating cash flow that we can redeploy to new companies as we go. But I like private credit in an increasing interest rate environment. Anything that generates current cash is valuable, more valuable.
Yeah, go ahead. I'm sorry.
Well, you can't generate current cash if the debt is soaking up all your cash, right?
Clearly,
right. Yeah, it's you mentioned kind of the capital stack or priority of sort of returns. That's a really interesting analysis to go through that I think some investors don't necessarily consider. But you're right. I mean, from a debtor perspective, you pay your debts first before the equity investors are able to participate. And I think it sounds like what you guys you're trying to sit almost in between, almost like preferred stock versus common equity, or going up into the full debt side.
Yeah, actually, it's brilliant that you said that. So it's so just to be clear for the
Don't say
audience,
he's brilliant. Don't say he's brilliant.
You'll never be able to live with him.
No, come on, really? That's those G2 go with that flow. Come on.
Well, so I said this before, like if you are private credit, then you're ahead of equity. But if there is no private credit and there's only 1 times debt, then the equity sits right behind that 1 times debt. It basically takes on the risk profile of blended bank debt and private credit, right?
Yeah.
I mean, if you had no debt and you were all equity, a certain portion of your equity would have a risk profile equal to bank debt.
Yeah.
So how far up you are in the cap stack determines your risk profile. Well, because we're only taking 1 times debt to profit, and you could take up to 5 times, that means there's 4 times of profit level debt that we're not taking that actually our equity gets to participate in at bank risk type profile. So it does act like pref equity in a lot of ways. So I usually analyze 2 things. What's the risk you're taking versus the yield you're getting? I think a lot of times people talk about what are my returns without reference to the risk they took to get those returns.
Oh yeah, no, that's risk adjusted return is really important metric to look at. Yeah,
it's the key, right?
Yeah.
I mean, if you take 60% risk to get 30% returns, do that 100 times and see how it works out for you, right?
Yes. Yeah.
Right. I mean, what I'd rather do is take 9% risk to get 20% returns over and over and over, and that's really that low debt profile with a higher yield profile of private equity.
Yeah, now that we're on risk, we talked at the first podcast with you that there's cycles. I guess you have to watch for interest rate cycles to get that value based look. And I know you stay on the value side. With the economy where we are today, I just saw the numbers came out this morning. Our growth rate was 1.1 this quarter, so it dropped from 2.6 from the previous quarter, year-end quarter. Do you see a shift for your success in your companies? Does the market affect your companies greatly, or is that something as an investor has to look at from just a point in time issue?
Well, so it does affect us. I mean, we're in the economy like anybody else. Right. We're diversified, so it doesn't affect the portfolio as much as it would in any one company. But I'll give you an example. Last year, we had one of our companies suffered a 76% increase in its cost of goods sold. Now, it still made money, but it made dramatically less than it did the year before. Overall, the portfolio still grew, though, right? And that's one of the differences in a cash-generating private equity portfolio versus a high debt, no cash generating private equity portfolio. If you suffer a pullback in one of your companies, all of a sudden you're tripping bank covenants and there's foreclosures. You have all kinds of issues you have to work through.
Right.
But think about this, quarter over quarter, John, that's more than a 50% drop, right?
Sure.
2.6 to 1.1, more than a 50% drop. So our last year, I think our annual returns were around 11% on our conservative valuation basis. And then from Q4, actually end of Q3 through Q1, we acquired 31% more profit through acquisitions with only 7% more capital raised. So think about that.
Yeah, that's awesome.
Roughly net at 24% increase in profit net of your capital raise. So we look at something we call EBITDA to invested capital or profit to invested capital. How much profit is being generated for every dollar invested? And so the way our fund works, very much like a Buffett fund, would be we kind of drift along a little bit sideways, generating cash. And then that cash goes to buy new companies and we shoot up. Then, of course, those new companies plus the old companies generate even more cash. Wait a period, accumulate cash, buy some more companies. So there's this ever escalating growth curve within our fund that's pretty fun to watch, actually.
So from a legacy standpoint, when you look at, and I know you're very savvy in the PPLI, private placement life insurance world, like we are. this would be a great legacy asset for that type of a structure because it is generational in focus on the PPLI side. So if you were going to look at a portfolio in that type of a strategy, what percentage would you put in private equity from a risk standpoint among other asset classes? What would that be?
Depends on the family. So the bigger the wealth, I think more in private equity. I mean, I can, again, the Nassim Taleb saying, ask the advisor what he's doing himself.
Right.
I'm in a little different position. And I believe just like Buffett and Munger, I should be the chief risk taker because I'm running the fund. So I can tell you I have about 60%, 65% of my net worth in the fund, about 3% in a little bit of buffer cash. And the rest of it really is in personal use assets. It's not in public markets. So I am all in on the fund because I kind of know how it works. I know how it compounds. And I think private placement life insurance is perfect for this because it also does generate annual K1s. Now, it's years before we have tax impact because we have depreciation and amortization that as we buy companies keep cycling through. But at some point, that mitigates, that tax benefit mitigates, and all of a sudden you have these K1s that are producing taxable income. It's perfect for PPLI. PPLI is a perfect place to house this. And if you're a smaller investor, maybe you'd be at, between 10 and 20%. And if you're a bigger investor, I think you, just like the hedge or just like the endowment funds, you push up to a much greater portion.
Yeah, they're like 40 to 50%, some of those endowments.
Sometimes 60.
Even more, It blew me away when I saw that. I could not believe it, but I was never in that world.
Yep.
When I started investigating it, I was absolutely blown away by the magnitude of the alternative world in these particular endowments. It's
well, that's why you're seeing, and look, pension funds don't have the same, they have a shorter term horizon than endowment funds. So those endowment funds and family offices with long-term legacy perspective, they can take longer term risk and they should be more heavily weighted towards private investments.
Yeah, it's just a wonderful asset class to, if you qualify for it, and I hope that somewhere the industry adjusts for maybe having the opportunity for people that don't qualify at this point can qualify, because I think this is just an asset class that people just miss out on if they don't take advantage of it, because I think this has some growth opportunities long term for families, especially the families that we work with, and you're very familiar with a lot of the families we work with because you're a part of that design phase. How would you look at enhancing your fund? I mean, is there anything else you could do to make your fund better than it is today, or you staying very strict to your processes?
I think we constantly make it better. Mostly through our own learning. One thing that we do in our fund that's pretty unique is we have our leadership teams from each of the companies get together twice a year as like a peer group mentoring program. They share information, share challenges, and that has been very successful. It does a couple of things. It develops relationships between the companies, so they are very comfortable reaching out to each other for help or for cross-selling, or for strategic new product launches. So there's a lot of collaboration between our portfolio that you don't really see in other private equity funds because, again, they have a shorter duration, a shorter timeline in which to execute. But our timeline is unlimited. And so twice a year in the spring and in the fall, we get our leadership teams together for about a 3-day kind of conference. And that conference is led. It's very specific. They have very specific educational goals we're trying to achieve during that time period. So training our people and our leadership teams has been very helpful and valuable, and something we continually try to improve on. That's been a big element of what we're trying to accomplish.
And I'm assuming you'll continue to recruit talent to your portfolio of managers. Am I correct in assuming?
Yeah, both at the fund level. Right now I think we could almost double in our size. Number of companies we could manage with our current team. Not quite double, but maybe 80% more. But we always want to find the best and brightest and be prepared for growth.
Do you have 11?
We have about 11 or 12 people right now.
Okay.
And our key people that really, beyond admin, key people that really manage in the portfolio. There's 3 of us at the fund level, and then that manage like that coaching aspect, and then 2 in the portfolio on the ground, on a more day-to-day roles where we need them.
Yeah, Chris, I think we're running up against sort of the ends of our time here today, but I wanted to if I can ask your thoughts on, I know that a lot of your investment philosophy is maybe looking towards baby boomer owned companies, and you gave some statistics in terms of how large that segment is. Obviously, there's going to be, you're not going to be able to provide a succession plan for all those companies, but I'm just more concerned about what you see in the global economy in terms of if they don't have an outlet like a fund that you're starting to develop and have developed, what other options are out there, and what's your forecast for just the business owner community? Or because is it going to be more aggregation in terms of creating larger companies and not as many mom and pop owned companies as maybe there were in the past? I'm just interested to get your thoughts on that.
Yeah, you might. So I read, there were several Wall Street Journal articles and several kind of business articles kind of at the beginning of this, quote, silver tsunami. And what it said was that most of these baby boomer owned businesses that do, say, less than 500,000 of net profit would simply close their doors. Nobody wants them. The kids don't want them. They all want to be internet influencers, right? TikTok dancers or whatever it is.
Right.
And the employees really can't afford them. And so I think you'll probably see an ever increasing rise, maybe smaller ESOPs. The problem with employee stock option plan, employee buyout, problem with it is it's an expensive process. And so at a certain level, it probably is too expensive for the company. So these companies at 500,000 of profit and less are really kind of stuck. They don't have a lot of options. I know there were several people who ran, say, a small grocery store or a gas station. And the offers to purchase those companies were basically equivalent to the land value.
Wow.
They just weren't buying the company. They were just buying the land. And they were just going to shut the doors of the business and then redevelop the land. So it is a tough problem. I don't know that there's any clear answers. Some of them can probably be rolled up. But in some ways, that's kind of how capitalism works, right? Certain aspects die off. I think if search funds, these young MBAs could come out and buy a big chunk of those smaller businesses like that from baby boomers, that would be a great accomplishment in our economy in total.
Chris, can you go global as well with your model?
We can. What we have found is that Canada and Mexico, we'd like to be in South America, Central America, and all of North America. We're in 2 countries right now. We've acquired 12 companies in 7 states and 2 countries. So we're in Canada. We have found that Europe and Central and South America, and even Mexico, their private equity markets are so underdeveloped relative to what we have in the US that it's a much tougher climb to even figure out how you'd execute on a company. There's no robust market of exchange like here we have, a really robust business broker, investment banker type market. It just doesn't really exist outside the United States. Even in Europe, it's just not robust,
Yeah, that's interesting.
Makes it harder. Yeah. But I was down in Mexico last week with one of our companies services some big 3 automaker plants down in Mexico. I am telling you, NAFTA has taken hold. Those plants are amazing. They're every bit as efficient and organized as plants I've seen anywhere. Yeah. And so some of those suppliers to those plants down in Mexico, we'd really like to start taking a deeper look at them. We made some relationships while we were down there. And so I think that there will be opportunity in maybe the non-cartel border county areas of Mexico. We can get.
Yeah, that'd be nice.
Yeah, exactly.
That's a good due diligence question to ask.
Yeah. How many cartel members do you know?
Yeah. Well, Chris, listen, this has been an awesome 2 podcasts, and I'm very confident we'll have you on again in the future. But I wanted to thank you for your time. I know you're a busy man, and it's been great to talk to you. It's been great to have you on. So thank you so much.
My pleasure. It was great to be here. Yeah, thanks, John. I am happy to come back anytime you guys want.
We'd love to have you back, no doubt.
Again, great conversation, gentlemen. So much information in here. Michael, give folks contact info so they could reach out and learn more about your guests and what you guys do.
Absolutely. You can reach us on our website. It is www.cbfgllc.com. You can call us on at the office here, area code 988-8300. And of course, we are on social media, LinkedIn. You can always reach out to us via those platforms as well.
Fantastic. Guys, again, great podcast. Thank you so much. And of course, the last thank you goes to you, listening audience. Thank you so much for tuning in and listening to the Truth About Wealth podcast with John and Michael Parise. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John and Michael come out with a new podcast, it'll show up directly on your listening device. We humbly ask that you share this podcast, rate it, and leave a review, as this actually does help other people find the show. Again, thank you so much for listening today. For everyone at Copper Beech Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Copper Beech Financial Group. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
This material is for informational purposes only. Neither APFS nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beech is not affiliated with American Portfolios Financial Services, Inc. and American Portfolios Advisors, Inc. Securities offered through American Portfolio Financial Services, Inc., a member of FINRA SIPC, investment advisory and financial planning services offered through American Portfolio Advisors, Inc., an SCC registered investment advisor. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Copper Beech is an unaffiliated entity of American Portfolios Financial Services, Inc. and American Portfolios Advisors, Inc. Any opinion expressed in this forum is not the opinions of American Portfolio Financial Services, Inc. and American Portfolio Advisors, Inc., and have not been reviewed by the firm for completeness or accuracy. American Portfolios and Copper Beech Financial Group are not affiliated with any other named business entities mentioned.